Hi everyone. I hope everyone is fine. Welcome to our channel. If this is the first time you come to our channel, please watch our previous videos, then you will understand this topic well. I will leave those videos and playlist links in cards. Okay, without wasting our time, let's get into the topic. Here is the topic. Okay, for simplification purpose, I am dividing this video into 7 topics. Let's see the topics. These are the topics. The first one is intro of Forex. Later, we will discuss the pips. And the third one is lot sizes. The fourth one is spread. And the fifth one is leverage. The final 2 chapters are most important. One is technical analysis, and the final one is fundamental analysis. So, these are the 7 chapters we are going to discuss in this video. So, without any wasting time, let's get into the main topic. Let's move to the first chapter, Forex basics. The word forex is a mashup of foreign exchange and is commonly used to refer to the foreign exchange market, the largest financial market in the world. Picture a massive marketplace trading across all the corners of the globe, but rather than having goods on sale, this market trades in global currencies. The forex market or foreign exchange market is one of the most widely traded markets in the world, with daily trading volume of over $8 trillion. If you guys live in the United States or like me in India and you've ever traveled to other countries for vacation, that's going to be your first introduction to foreign exchange. For example, when you travel to India right now, if you give them $1, they will give you 88 rupees. That is the current exchange rate. So if you exchange $100, you will get 8,800 rupees. You can have a lot of fun in India with a dollar. Now we can get into the deeper stuff. Let's look at Euro US dollar. This is the most commonly traded currency pair. And right now, for €1, you would need $1.04. Now you might be asking yourself, what does that mean? And how do I make money off of it? When you are trading currency pairs, we will discuss that later. Because when you trade Forex, you are buying one currency while selling another at the same time. Let's look at the pound dollar currency pair, for example. The first currency in a pair is the base currency, and the second currency is the quote currency. Let's say you get a quote of pound dollar as 1.26. This means for every 1 pound you get 1.26 of US dollars. There is always an invisible one beside the base currency on the left. So here's what happens when you actually trade currency pairs. When you buy a currency pair like the pound dollar, or when you go long on the pound dollar, you're expecting the pound to appreciate while the dollar depreciates. When you sell a currency pair like the pound dollar, or when you go short on the pound dollar, you're expecting the pound to depreciate while the dollar appreciates. Major currency pairs. These are the major currency pairs, which all include the US dollar. I think you understand the term Forex and the code of Forex pairs. So, let's move to the next chapter, pips. What is a PIP? In the land of Forex, exchange rate changes are measured in pips. A PP stands for a percentage in point or a price in trust point. This is a standardized measurement for the smallest whole unit price move that an exchange rate can make. If the euro dollar is sitting at 1.04420 and its value gained by 1 pip, it would move 0.04430. Most currencies are written to the fourth decimal place, with the fourth decimal place representing 1 pip. However, some exceptions buck this trend, such as with the yen-crossed pairs. The Japanese yen often quoted to 2 decimal places. So 1 pip gain would be 151.991 rising to 152.001. There's also a pipette, which is a fractional pip that is 1/10 of a pip and is represented by the 5th decimal place. Before we continue, we want to hear from you. If you have any doubts, tell us in the comments below right now. Okay, I think you understand the pips topic. How to calculate the pips. Okay, let's move to the next chapter, lot size. In Forex, positions are usually measured in lot sizes. A standard lot represents 1 lakh units of the base currency. A mini lot is a tenth the size of a standard lot and represents 10,000 units of the base currency. A micro lot is 1,000 units of the base currency, and a nano lot is 100 units of the base currency. A standard lot is a unit of measure of the amount that you're purchasing. So for example, if Euro USD is 1.04 and you want to trade one standard lot, which is 1 lakh units in order to place that trade, You need $1,13,000. So, this is how the lot size works. If you don't have more capital, at the same time, if you have the trading skills, there is no one to stop you. 0K. This is a brief note on the lot size. Let's see the next chapter. Spreads. Each transaction has a bid and an ask price. These two prices form the basis for trading on the Forex market. When you're looking to buy an asset on the Forex market, you will pay the ask price for the base currency. When you're looking to sell an asset on the Forex market, you will sell at the bid price. The difference between the bid and ask price is called the spread. Spreads are enemy to us because due to spreads your stop loss may hit. That's why you have to choose a best broker. The bid-ask spread is the difference between the price a dealer will buy a currency and what they will sell it for. The spread covers the dealer's profit and the cost of the transaction. It is essentially the cost you pay to enter the market. It's important to note that different brokers can offer different spreads, or they may offer variable spreads that can change based on market conditions. Spreads are enemy to us. So select a best broker. Who gives the tight spreads? Okay, let's see the next chapter. Leverage. Brokers and leverage. You, as an individual retail trader, require a broker to access and trade the Forex market. Brokers provide leverage, which is you using borrowed capital from the broker to trade larger positions than you otherwise could with the amount of money in your account. Imagine leverage like using a financial lever. With a lever and minimum strength, you can lift heavy loads with less effort. Like a lever that magnifies physical strength, financial leverage magnifies your trading power. Essentially, leverage turns up the volume on trades. However, with the potential for more profit, leverage may attract you. But the high leverage is very dangerous. If you take high leverage, it means you're sitting on a snake's case. At any time, it will kiss you. It's important to keep in mind that leverage can act as a double-edged sword. Leverage offerings vary from broker to broker and are usually expressed in a ratio such as 1 to 50, 1 to 100, or 1 to 500. Usually, traders will be required to deposit a margin of the trade to act as collateral for the leverage position. So this is the basic to advanced level of discussion on leverage. I hope all your doubts are clear. Even though if you have any doubts, let me know in the comment section. So, let's go to the next chapter, technical analysis. With technical analysis, traders study historical price movements and data in order to identify similar patterns that have the possibility of repeating themselves in the future. The idea here is that the market is not going to be able to do that. History loves to repeat itself. Think of technical analysis like a detective hunting down clues to uncover how an individual acted in the past in order to try and predict how they will act again in a similar way in the future. Here are a few simple examples of technical analysis in action. Let's see the chart. See, this chart looks like an uptrend. How can I tell without using any indicators or using any structure breakdown? Here the point is to know the positions of the highs and lows, and moreover the candlestick types. See, here the price forming higher highs and higher lows. What it means, price in uptrend. What should we do when price in uptrend? We will take only the buy trades. So in trend, that means now we're expecting this price will move upward, but we don't know the exact range, exact time of the next pump. That's why here the strategies came. If you have an excellent strategy, it will signal you the exact timing to capture the move at right time. That's I came with the Hope Pip strategy. Don't confuse with this name. It is nothing but support and resistance strategy. Just you have to do is practice it in the simulation sessions. Master the setups I am teaching you. Those are very important. If you don't know how to watch them, I will give the links in the cards. You can watch them from here. Let's see what will happen next in this chart. See, as we predict price moved upward. That's why I'm telling you all the time. Please focus on the price action. Don't depend on the lagging indicators. Okay, let's go the last chapter. Fundamental analysis. Fundamental analysis determines the intrinsic value of an investment to determine its value rather than historical price action or market sentiment. Forex traders look at the economic conditions that affect the valuation of a nation's currency. There are many economic indicators and private reports that can be used to evaluate Forex fundamentals. It involves analyzing a country's economic indicators, central bank decisions, political events, and other fundamental factors to predict the future direction of a currency's price. If you think about it, this makes a whole lot of sense. Just like in your Economics 101 class, it is supply and demand that determines price, or in our case, the currency exchange rate. Using supply and demand as an indicator of where price could be headed is easy. The hard part is analyzing all of the factors that affect supply and demand. For example, let's say that the US dollar has been gaining strength because the US economy is improving. As the economy gets better, raising interest rates may be needed to control growth and inflation. Higher interest rates make dollar denominated financial assets more attractive. In order to get their hands on these lovely assets, traders and investors have to buy some US dollars first. This increases demand for the currency. As a result, the value of the US dollar will likely increase against other currencies with lesser demand. Since currencies are always paired, their performance is determined relative to that of another currency. Like this, the fundamental analysis works. So you have to do is connecting the points and imagine the whole structure and enter the room of 1% club. Okay, this is the fundamental analysis basics. Actually, it needs a dedicated video. In future, I will make a separate playlist on the fundamental analysis. If you watch this video up to this, I think you might like my videos. Please subscribe to this channel for more content like this. Share this video to your trading friends. Click on bell icon for faster notification when I uploaded videos in this channel. Thank you. This is the end of the video.